Simon Maughan is head of sales and distribution at MF Global. He joins me now. Simon, good to have you on the show. Thanks very much indeed for joining us. And I guess really one of the big takeaways from these bank results so far has been the write-downs on their holdings of Greek government debt.
Well, absolutely it has. And of course, the interesting thing about it is that while they're writing down banking books, which the EBA stress tests didn't bother to look at, they're not writing them down by the type of figures that people expect to see. BNP yesterday arguing that the market price for Greek debt was all wrong, that they get paid back for any Greek debt that has a maturity over 10 years, and thus just taking a 21% hit on anything maturing prior to 2021. SocGen mirroring that 21% write down today, but I think, pick a number out the air, but most market commentators do expect to see at least a 50% write down on all Greek debt to be really satisfied this issue had been dealt with.
Okay, so just to be clear about this, you're saying that they didn't write down by as much as we were expecting?
They didn't write down by as much as the market is predicting Greece will default by. What they did do was write down the element of the deal, the voluntary restructuring that's taking place on all bonds with a maturity of less than 10 years. They wrote that down by the specified amount in that voluntary agreement. But market pricing of Greek debt suggests a far bigger write-down.
So further write-downs to come in the next few months, into next year? Yes,
that's definitely the case. We're not sure, though, that's why SocGen's questions its 2012 net income target, because they are able to continue to write down Greek debt while remaining profitable, albeit at a low level. We think probably the question mark and the real negative in the stock price this morning is because they're really telling you that their investment banking business and probably also their international retail banking business can't generate the growth that as early or as recently as May they said it was going to.
Oh, okay, that's interesting because SocGen writing down close to 400 million euros in their Greek debt holdings, but you're saying actually it's more about a slowdown in investment banking revenue, which has also been a sort of a theme across the board, right?
Absolutely, and actually the investment banking performance at SocGen, as indeed at BNP, was at the upper end of the peer group. You can look at those numbers and say, off 20% quarter on quarter. That's a reasonably resilient performance given what other banks have delivered, but clearly into their expectations for 2013 and possibly beyond. Management had built in some more aggressive targets, which they now just don't think can be delivered.
So then, are we seeing any evidence of a lessening reliance then on investment banking revenue?
Well, a lot of that has to do with the impairment trends. And the impairment trends, if you back out the Greek debt, which of course is a dangerous thing to do because it exists and write-downs will be necessary, but impairment trends are down to 58 basis points of loans across the board. It's pretty much every division that's improving, and that in itself will pick up the business from the non-investment banking side. We should also say that the French banks also have got reasonable balance sheet growth across their businesses, again when you make a comparison with European banks. So the core operating businesses, generally French banks are doing well, but it's the problem of this Greek and ultimately Italian debt that they hold that's really worrying the stock price.
And is that going to continue to be the case then for the rest of this year and indeed next year? I mean, SocGen already voicing concerns about its 2012 target, though you're saying that doesn't have as much to do with the Greek government debt holdings as we would expect. But at what point might we see more of a turnaround then in fortunes?
Yeah, well, I mean, look, if we back up to BNP yesterday, they've got 4 billion of Greek debt. They've chosen to take write-downs on 2.3 billion. They could write down over the next year 1/2 of all their 4 billion exposure and maintain a double-digit ROE, which would justify a stock price on a price-to-book basis probably 33 to 40% higher than the current share price. It's clearly not the Greek debt that's worrying people. It's largely the Italian situation. Now, the UK has shown us you don't actually have to cut spending immediately in order to calm the market. You just have to present a credible plan for deficit reduction in the medium term. At the moment in Italy, though, we have no political leadership, no credible medium-term plan, and the market is saying the Italian debt is now spiralling out of control, and that will have a direct knock-on impact to France.
Just a very quick final one. Then, can you just tell me? You said that the French banks doing pretty well, strong balance sheets. How will the Italian banks fare in comparison?
Well, the French business, domestic business, is reasonably resilient. There's a high savings rate. There's a low level of personal indebtedness. So you're getting some mortgage growth, some card growth. The French economy is relatively stronger than the Italian one, and so you're getting some better business growth. You've also got these businesses. The French businesses are very focused on areas where they're strong, like equity derivatives, like security services. They've got good concentrated business models. Their problem is their sovereign debt exposure. If you go to Italy, then you're dealing with a much more fragile domestic economy. You're dealing with a much bigger relative positioning in Italian government debt, and it's the question marks over that Italian government debt that's caused the Italian banking share prices to crater in the last 4 to 6 weeks.
Simon Maughan of MF Global, thank you very much indeed. Great to get your analysis on that. Appreciate your time.